Why does everything cost more while experts say the economy is fine? The answer involves 6 forces nobody talks about. Understanding these forces could save you from disaster ahead. The infrastructure nobody sees in the first half of 2025. Artificial intelligence capital spending contributed 1.1% to America's GDP growth. That sounds technical until you realize what it means. AI investment added more to economic growth than consumer spending. More than people buying cars, houses, and appliances combined. This is not about chatbots or algorithms. This is about concrete, steel, and semiconductors. Companies are building data centers the size of football fields across America, Europe, and Asia. These facilities consume as much electricity as small cities. Each one costs billions of dollars to construct. The AI market reached $244 billion in 2025. By 2030, analysts project it will exceed $800 billion. But most of that money isn't going into software. It's going into physical infrastructure. NVIDIA and Microsoft both hit stock valuations above $4 trillion, driven almost entirely by infrastructure investment expectations. The scale is staggering. Goldman Sachs estimates AI investment could approach $100 billion in the United States alone by year's end. Tech companies are issuing bonds at unprecedented rates to finance this build-out. The debt is piling up faster than revenue can justify it. Corporate America is spending money on AI infrastructure at rates not seen since the railroad boom of the 1800s or the internet bubble of the late 1990s. In the third quarter, tech-related capital expenditures contributed 4.3 percentage points to overall business investment growth, offsetting declines everywhere else in the economy. Data centers now account for 1% of global energy demand. By 2030, that figure will triple to over 3%. Utility companies are scrambling to build new power plants and transmission lines just to keep up. Bitcoin miners are pivoting their operations to lease computing power to AI companies because the margins are higher. This spending is propping up economies that would otherwise be slowing. Strip out AI investment, and American GDP growth in early 2025 would have been barely positive. The European economy would be in recession. But there's a problem. Most AI companies aren't profitable yet. High performers report enterprise-wide earnings impacts of just 5% from AI use. 80% of AI projects fail before reaching production. Microsoft's CEO recently warned there may be an overbuild of infrastructure. The question hanging over global markets is simple. Is this the foundation of a productivity revolution that will drive growth for decades? Or is this the biggest misallocation of capital since the dot-com crash? The Great Unraveling. For 50 years, global trade operated on a simple principle. Companies bought from the cheapest supplier and sold to the biggest market. Politics rarely interfered. That world is over. The World Trade Organization released stunning projection in early 2025. Merchandise trade between the United States and China could collapse by 80%. Not slow down, collapse. The two largest economies on Earth are economically divorcing, and the fallout is restructuring global commerce. Trade between geopolitical blocs is contracting faster than trade within these blocs. The average geopolitical distance of trade has fallen 7% since 2017. Countries are now choosing partners based on political alignment rather than economic efficiency. Alliances are replacing supply chains. The United States is imposing tariffs on multiple fronts. China, Canada, Mexico, and the European Union all face new trade barriers. China is retaliating with its own restrictions. Europe is caught in the crossfire, implementing defensive tariffs while trying to maintain relationships with both powers. The consequences are massive. American companies that relied on Chinese suppliers face cost increases they cannot absorb. Some are passing costs to consumers, others are searching for alternative sources in Vietnam, Mexico, and India. But moving a supply chain takes years and billions of dollars in investment. Germany relied heavily on Russian energy before 2022, when that supply vanished overnight. The country engineered a swift but painful reconfiguration. German industrial output is still recovering. German companies are now diversifying energy sources at enormous expense, prioritizing security over cost. Connector countries are emerging as winners in this fragmentation. Mexico and Vietnam are capturing market share as intermediaries. Chinese exports flow to these countries, get assembled or repackaged, then shipped to the United States. Supply chain extends rather than breaks. But even these countries face risk. Washington is watching closely. Europe faces a particular problem. The continent is a collateral victim of American protectionism and Chinese trade aggression. European exports to America face 15% blanket tariffs. Meanwhile, cheap Chinese goods flood European markets as China redirects products away from America. European manufacturers are squeezed on both sides. The shift is permanent. Even if tensions ease, companies will not rebuild the old supply chains. They are investing in redundancy, building parallel systems across multiple countries. This approach is more expensive and less efficient, but it reduces political risk. Global efficiency is dying, security is replacing it, and that transition is costing trillions in lost productivity and higher prices. The price of money every month, a group of economists gathers in Washington, Frankfurt, London, and Tokyo to make decisions that affect billions of people. They set interest rates. Most people ignore these meetings. They shouldn't. These decisions determine the cost of every loan, every mortgage, every business investment on the planet. The Federal Reserve cut interest rates to a range of 3.5 to 3.75% in December 2025. This marked the third consecutive cut, bringing borrowing costs to their lowest level since 2022, but the decision was anything but unanimous. 3 committee members voted against the cut, something that hadn't happened since September 2019. Stephen Moran wanted a deeper reduction of 50 basis points. Austan Goolsbee and Jeffrey Schmid argued for holding rates steady. The Federal Reserve cannot even agree internally on the right course of action. That tells you everything about how uncertain the economic environment has become. Central banks face an impossible balancing act. Cut rates too quickly and inflation roars back. Businesses raise prices, workers demand higher wages, and the cost of living spirals upward again. Cut rates too slowly, and economic growth stalls. Companies stop investing, unemployment rises, and recession threatens. The European Central Bank has been more aggressive. The main policy rate now stands at 2%, down from a peak of 4% in 2023. The Bank of England cut its rate to 4.25%. Meanwhile, the Bank of Japan is moving in the opposite direction, raising rates from below zero for the first time in years. These diverging policies create their own problems. When the Federal Reserve cuts rates, while the Bank of Japan raises them, currency values shift dramatically. The dollar weakens against the yen. That affects trade balances, corporate profits, and international investment flows. Central banks are targeting what economists call the neutral rate. This theoretical level neither stimulates nor restricts economic activity. But nobody knows exactly where neutral is. Estimates for the United States range from 2.75% to 3.25%. For Europe, estimates fall between 1.5 and 2.5%. The stakes are enormous. Get it wrong in either direction, and millions of jobs disappear. Businesses that borrowed money at low rates now face refinancing at higher costs. Governments with massive debts find interest payments consuming larger portions of their budgets. Central bankers are flying blind through fog, making their best guesses about where to steer. The rest of us are passengers hoping they get it right. The dragon's metamorphosis. China's retail sales grew 1.3% in November 2025. That was the slowest monthly growth since 2022, missing every analyst forecast by a wide margin. Industrial production climbed just 4.8%, its weakest performance since August 2024. Fixed asset investment contracted 2.6% over the first 11 months of the year. These numbers tell a story of economic slowdown, but they only tell half the story. China is not simply slowing down. The country is undergoing a fundamental transformation that most Western analysts completely misunderstand. Traditional sectors are collapsing while advanced manufacturing sectors are surging. The overall economy looks weak because the old engine is dying even as a new one revs up. The property sector is in free fall. Real estate investment has plunged by nearly 13%. New home prices are down more than 12% from their peak. Used home prices have fallen over 20%. Property was the primary store of wealth for Chinese households. But wealth is evaporating, and consumer confidence is collapsing with it. Chinese households are saving rather than spending. Bank deposits rose 7.4% in the first 9 months of 2025 compared to the STO period in 2024. People are hoarding cash because they fear the future. This savings surge is starving the domestic economy of consumption. But look at what China is exporting: electric vehicles, solar panels, advanced batteries, semiconductors, and industrial robots. China installed 276,000 industrial robots in 2023, 6 times more than Japan and over 7 times more than the United States. Chinese companies now control over half of global robot installations. Solar exports to emerging economies doubled between 2022 and 2024, overtaking exports to wealthy nations. Brazil, India, Pakistan, and Saudi Arabia are buying Chinese solar technology at unprecedented rates. China is electrifying the developing world while its own consumers pull back spending. The high-tech sector represents less than 20% of China's total economy. Manufacturing and technology are growing rapidly, but they cannot offset the broader weakness in construction, services, and consumption. This explains why GDP growth hovers around 5%, even as Chinese companies dominate global markets in key industries. Western policymakers are making a critical error. They see the economic slowdown and assume China is weakening across the board. They are confusing macro weakness with micro dominance. China is losing in real estate and consumer spending, but China is winning in electric vehicles, renewable energy, and advanced manufacturing. The second largest economy in the world is simultaneously in crisis and conquest, and that paradox is reshaping global competition in ways most people have not begun to understand. The energy gap: global spending on clean energy reached $2 trillion in 2024, but the number required to actually meet net zero targets by 2050 is $5.6 trillion annually. Between now and 2030, the world is investing less than half of what is needed. This gap is not an abstract problem for future generations. It is creating bottlenecks and distortions in markets now. 1,650 gigawatts of solar and wind capacity sat waiting for grid connections in 2024. That is 6 times Germany's generation capacity, sitting idle because the electrical grid cannot absorb it. Companies built the power plants, but the infrastructure to transmit that electricity does not exist. Transformer and cable prices have surged by 1/3 since 2022. Delivery times have doubled to 2 or 3 years. Building new transmission lines requires permits that take years to obtain. Local communities fight every proposal. The grid itself has become the primary constraint on the energy transition. Solar and wind installations are projected to double by 2030 compared to 2024 levels. But policy changes in the United States could reduce that growth by 30%. The Trump administration rolled back clean energy tax credits. This policy shift could cut residential solar adoption by 46% through 2030. China is advancing faster than any other nation. China established a unified electricity market for renewables in 2024. China approved expanding its national emissions trading system to cement and steel industries. Chinese solar exports are flooding emerging markets, while domestic installation rates continue climbing. Europe faces its own challenges. Tariffs on Chinese solar panels and batteries are raising the cost of the transition. European companies cannot manufacture these products as cheaply as Chinese competitors. The choice is between domestic production for security or cheap Chinese imports that create dependency. Electric vehicle adoption is accelerating in developing nations. Brazil, India, and Pakistan are importing Chinese EVs that surprised analysts. But in Europe, EV sales growth slowed in 2024. Due to poorly designed emissions regulations that incentivized automakers to delay new models until 2025, the energy transition is happening. Solar capacity is expanding. Wind farms are being built. Electric vehicles are growing, but the pace is insufficient. Every year of delay makes the eventual transition more expensive and more disruptive. The gap between ambition and reality keeps widening, and that gap is reshaping energy markets, creating stranded assets, determining which countries will lead in the low-carbon economy. The demographic divide: Mexico's unemployment rate stands at 2.6%. South Africa's is 32.9%. These numbers reveal a fundamental split in the global labor market. Some countries cannot find workers, others cannot find work for their workers. Rich countries are aging rapidly. Japan, Germany, Italy, and South Korea face shrinking workforces. More people retire than enter the job market annually. Companies in these nations struggle to fill positions. Factories cannot run full shifts because workers do not exist. Poor countries face the opposite problem. Sub-Saharan Africa, South Asia, and parts of Latin America have youth bulges. Millions of young people enter job markets annually. But these economies cannot create enough positions. The result is mass unemployment and underemployment. The United States labor force participation rate has fallen to 62.2%. Baby boomers are retiring in massive numbers. Immigration restrictions have tightened, reducing foreign-born workers who previously filled labor gaps. The American workforce is shrinking, even as companies desperately need employees. New Zealand maintains a labor force participation rate of 70.5%, but even that figure is declining. High-income countries face a mathematical problem with no easy solution. Fewer workers must support more retirees. Tax bases shrink while pension obligations grow. The skills gap is widening. Technology, AI, cybersecurity, and data analysis, jobs go unfilled because workers lack necessary training. Meanwhile, traditional manufacturing and service jobs are disappearing as automation advances. Workers displaced from old industries cannot easily transition to new ones. Companies are responding by moving operations to where workers exist. Manufacturing is shifting to Vietnam, Bangladesh, and Mexico. Service centers are relocating to India and the Philippines. Capital is chasing labor. Artificial intelligence is accelerating this transformation. 32% of survey respondents expect AI to decrease their organization's workforce size in the coming year. But others see expansion. The employment impact of AI remains uncertain and varies dramatically by industry. The Conference Board found that 42% of chief people officers expect continued labor market turbulence in 2025. Hiring strategies that worked 5 years ago no longer function. Skills that were valuable are becoming obsolete. Workers who cannot adapt face diminishing prospects. This demographic divergence is permanent. Birth rates in wealthy nations continue falling. Populations in developing nations continue growing. The global labor market is splitting into two separate realities, reshaping where companies invest, where growth happens, and which countries prosper. The collision, these six forces are colliding in ways that amplify some effects while canceling out others. The interactions are creating outcomes nobody predicted. AI data centers require enormous electricity. This demand is accelerating as the world tries to transition away from fossil fuels. Power companies are building natural gas plants to keep data centers running, undermining climate targets. The energy transition and AI boom are on a collision course. Trade fragmentation is making the energy transition more expensive. Solar panels and batteries are manufactured primarily in China. Western countries want energy independence from fossil fuels while simultaneously wanting supply chain independence from China. These goals contradict each other. Tariffs on Chinese clean energy products raise decarbonization costs. Central bank interest rate policies determine borrowing costs. The energy transition requires trillions in infrastructure investment. Higher interest rates make that investment more expensive. Every quarter-point increase adds billions to wind farm, solar array, and transmission line costs. Monetary policy is directly constraining climate action. China's economic slowdown is reducing global commodity demand. This should lower prices and ease inflation. But China's manufacturing surge is creating overcapacity in key industries. Chinese companies are dumping cheap electric vehicles, solar panels, and steel onto global markets. This benefits consumers, but destroys domestic industries. Demographic pressures are driving automation adoption. Countries with aging populations and labor shortages are investing heavily in robotics and artificial intelligence. This creates a feedback loop. Labor shortages accelerate AI development, which eliminates more jobs, changing labor dynamics further. Trade wars are accelerating nearshoring and friendshoring. Companies are building factories in Mexico, Vietnam, and Eastern Europe to avoid tariffs. But these countries often lack skilled workers needed for advanced manufacturing. Countries with available labor lack skills, while countries with skills lack labor. The Federal Reserve cuts interest rates to support growth. But AI investment is already driving growth beyond sustainable levels. Adding monetary stimulus on top of an investment boom risks creating bubbles. Central banks are trying to stabilize economies that AI spending is destabilizing. These forces cannot be understood in isolation. They're part of a single system. Change one variable, and three others shift. Policymakers focusing on individual problems are missing the larger pattern, reshaping global markets faster than institutions can adapt. The new reality: your mortgage rate is being set by central bankers trying to balance inflation against recession. Your job security depends on whether AI eliminates your role or creates new opportunities. Your electricity bill reflects data centers competing for the same power grid. Your grocery prices are rising because supply chains are being rerouted for political reasons. Everything is connected, and that connection is tightening. The global economy is entering sustained turbulence. The smooth globalization of the past 3 decades is over. The predictable relationship between interest rates and growth is breaking down. The assumption that technology always creates more jobs than it destroys is being tested. What makes this moment particularly dangerous is the speed. Previous economic transformations unfolded over decades. The Industrial Revolution took a century. Its current collision is happening in real time, faster than institutions can process. Governments are responding with outdated playbooks. They treat trade policy, monetary policy, and industrial policy as separate domains, but these domains are now inseparable. A tariff decision affects energy costs. An interest rate change impacts AI investment. Companies are adapting faster than governments. They are building redundant supply chains. They are investing in automation to offset labor shortages. Businesses that move slowly are losing to competitors that understand the new rules. Workers face the most uncertainty. Skills that were valuable 5 years ago may be obsolete in 5 more. Industries that seem stable are vanishing. The 6 hidden forces shaping global markets are no longer hidden. AI infrastructure spending is visible in electricity demand. Trade fragmentation shows up in reshuffled supply routes. Central bank decisions move markets every month. China's transformation is evident in export data. The energy transition gap appears in grid bottlenecks. Demographic divergence manifests in unemployment lines. These forces are not temporary disruptions. They are permanent features of the new economic landscape. Your financial future depends on how well you navigate the world they are creating.